In this video, we're going to go over the top dividend paying company from every sector in the market. The overall stock market is made up of 11 individual sectors, and we have the top dividend paying company from each of these sectors. Overall, each sector makes up a different weighting within the S&P 500. You can see information technology makes up around 25% of the index, and the smallest sector is materials, which only makes up around 2.5%. And for each of these sectors, we're going to go over a top dividend paying company within each, go over their current financial position, the dividend yield, dividend growth rate, and of course, we're always going to take a look at the dividend safety score to show the long-term sustainability of the dividend. If you're new here, everyone, I am the Gen Z investor, and every single day we talk about the stock market. We go over different stocks you can buy and sell within your own personal portfolios, and of course, we go over any major market news and headlines. And in this video, we're going to go over a top dividend paying company from each and every sector of the market. So stay tuned for all 11 stocks on today's video. So please hit the like button, subscribe to the channel, and we're going to get right into the first pick on the list, which is Microsoft. They are one of the largest companies in the world and currently trade at an over $1.62 trillion market cap. The company is up 41% this year, and they are representative of the information technology sector. We're starting off with Microsoft today because infotech is actually the largest sector within the S&P 500, making up more than 25% of the index. And Microsoft is a market leader across the globe, and I believe they will continue to dominate over the next decade with ease. The company adapts to new trends very easily, they're nicely diversified, and some of their new high-growth sectors continue to outpace their competition. Their cloud sector within the Microsoft ecosystem has been growing at a massive rate year over year and is expected to continue to perform very nicely. And this company has some of the strongest financial statements across the entire market. Revenue and net income continue to grow at a massive rate each and every year. They have a ton of cash on the balance sheet, and overall, they are so strong financially that I don't see any other competitor knocking them out of one of the top spots in the market anytime soon. With regard to dividend, the starting yield comes in at just over 1%, but this video is not about the highest dividend paying companies within each sector of the market. This dividend video is about some of the top stocks, some of the top dividend payers within each sector. Not the most high yield, but overall nice companies with nice total returns, high dividend growth rates, and will provide consistent dividend growth over the next few years, along with some share price growth that will have a nice total return to your portfolio moving forward. If we were to make a video about the highest dividend paying companies within each sector, you may be getting a list of some, kind of companies who've seen a large, sharp decline in share price, may not have a bright future up ahead, and may be actually on a downward trend. We're going to focus on companies who still have some strong future potential moving forward. And one of those companies, of course, is Microsoft. They only pay out around 33% of their net income as a dividend, so a ton of room to reinvest back into the business and a lot of room to continue to grow that dividend payment moving forward. And they average over 10% dividend growth each and every year, tied along with the highest dividend safety score possible at 99. The dividend is considered very safe and absolutely no worry about a dividend cut coming anytime soon, and that's why they are the representative of the infotech sector for one of the top dividend paying companies. Moving on to the second sector of the market, we have Pepsi, one of the strongest dividend growth companies to buy across the entire market. They are up over 7% this year. They currently trade at a market cap at around $200 billion, and their current dividend yield sits at 2.84%. This company comes from the consumer defensive or consumer staple sector of the market. And this is a sector where, regardless of what's going on in the economy, people still have a demand for the products and services of these companies within this sector, and Pepsi is one of the top dividend paying companies that is a consumer staple. They have a nice current dividend yield at 2.84%, and have a dividend payout ratio of around 74% of their earnings, and grow their dividend at over 8% per year, and they have a beautiful dividend growth history at 48 years. So very close to becoming a dividend king, and it just shows that this company can continue to grow their dividend during recessions, during depressions, and good or bad times no matter what. And Pepsi is a company with a very safe dividend, ranked at 93, so absolutely no worry about a dividend cut coming anytime soon, and I believe they will continue to grow that dividend, of course, over the next 2 years to become a dividend king and for long into the future. They have some great acquisitions as of late, acquiring different snack food brands. They're diversifying away from just soft drinks. All their different snack food brands have seen increased demand because of the pandemic, As people spend more time at home, they spend more time snacking, less time eating out at restaurants, and Pepsi has seen some beautiful growth from this shift in consumer behavior. If we move on to the third company on today's list, from the third sector of the market, we have the Home Depot. They are up over 25% this year and currently trade at around $294 billion market cap, and their current dividend yield sits at 2.19%. So this company comes from the other consumer sector of the market, the consumer discretionary sector. So this is a type of company where during good times, people will use their services. During bad times, they aren't really sell or produce necessities in the market. But Home Depot is probably one of the most consumer staple-ish companies from the consumer, cylindrical or consumer discretionary sector of the market. And I believe this company will continue to expand. I think they are one of the retailers that will continue to grow moving forward, and the pandemic has really expanded the need for their products and services. They are a home improvement retailer, and as people have been stuck at home for months, everyone feels the need to renovate and improve their houses. And Home Depot provides all the goods and services to do just that. If we take a look at the dividend, they currently yield 2.19%. They only pay out 50% of their earnings as a dividend, and they are one of the best and fastest dividend growth companies on the market, growing their dividend per year at over 23% averaged over the past 5 years. And with a dividend safety score of 87, another company, very safe dividend, absolutely no worry about a dividend cut coming anytime soon from Home Depot. On to the fourth stock in the list today, in the fourth sector of the market, we have the healthcare sector. This company is the second largest weighting in the S&P 500, making up more than 15%, and this company we're choosing today is Johnson & Johnson. Up around 4% this year, with a current dividend yield at 2.8% and a market cap of $378 billion. Of course, they come from the healthcare sector of the market, and this is one of the strongest dividend-paying companies on the entire stock market, with one of the largest by market cap at over $300 billion, with a current dividend yield at 2.8%. They only pay out around 50% of their earnings as a dividend, and they grow that dividend, averaging over 6% growth each and every year, and they are a dividend king with a 58-year consecutive dividend growth streak. And with the pandemic, they are working towards getting a vaccine on the market in 2021, which I believe will see a nice little boost to their top line as well. With regard to dividend safety, coming in at 99, the highest dividend safety score possible, absolutely no worry about a dividend cut coming anytime soon from Johnson & Johnson. Coming in at number 5, we have Verizon Communications. Ticker VZ, up only 1.7% this year. They have a market cap at around $250 billion with a massive dividend yield at 4.15%. Of course, they come from the communication services sector of the market, which is the third largest, making up more than 10% of the S&P 500. This is one of the higher dividend yielding companies on today's list, yielding over 4.15%. They only pay out around 51% of their earnings and grow their dividend slowly, averaging only 2.5% growth over the past 5 years. And we all know with the expansion of 5G, Verizon is one of the companies that is well positioned to see some upside potential over the next 2 to 5 years once 5G really begins to expand. They are one of the largest communication companies within North America, one of the safest and high dividend yielding companies that dividend investors love to hold, and I do prefer them over AT&T. I know that it's tough to say when AT&T is yielding over 7%, but I think over a longer term perspective, Verizon will provide the better total return to investors over the next decade. Their dividend safety score is still considered very safe, coming in at 87, so absolutely no worry about a dividend cut coming over the short term for Verizon. Sector number 6 is financials, and we're going with JP Morgan Chase. They are one of the largest financial institutions in the world with regard to assets, and this is a company that I believe will continue to grow their dividend once the economic recovery takes place and once we see some growth in the market. So ticker JPM is only down 7% this year. They took a massive decline, losing more than 40% of their value in the month of March, but of course, they are one of the companies that has seen a pullback as of late, as we've seen some hopes of the economic recovery. They have a market cap of over $370 billion, and of course, they are one of the largest financial institutions, so of course, they come from the financial sector of the stock market. This company currently yields around 3%. They only pay out around 48% of their earnings, and when they were allowed to grow their dividend before the pandemic, they averaged over 16% annual dividend growth. And JP Morgan and their CEO, Jamie Dimon, he's one of the more conservative financial company CEOs. I really do like how he's bolstering up the company's financial position. I really do like how he's managing the company, and I think JP Morgan will continue to expand very nicely. They're adapting to new innovations, they're competing against the young fintech companies PayPal and Square with new products and services, and overall, I think this is a winner in the financial sector. Their dividend safety score is considered borderline safe, coming in at 60. Of course, with all the uncertainty in the market with regard to loans and credit losses, that is kind of what led to the decline in dividend safety score for JP Morgan over the past few months. But I really don't think the dividend will be cut. I think they will maintain their dividend payments, and once they are allowed to, I think they will pick up where they left off, growing that dividend at a massive rate each and every year. Number 7 on the list is Digital Realty Trust. We're on to the REITs. DLR comes from the real estate sector of the market, and they are a specialized REIT. And of course, the REITs are known for having some higher yields, yielding over 4 or 5+%, but this is a company that is up 14% this year, with a current dividend yield at 3.3%. The market cap sits at around $39 billion, and this is one of the REITs that I think will expand very nicely over the next decade. Because this is not a traditional REIT. They are a specialized REIT, and they own and operate data centers. With the expansion of technology and our entire world revolving around data, cloud-based data, and every single type of data we need will come from a data center, and I think DLR is well positioned to see some massive growth moving forward. Just taking a look at the dividend, a nice yield at 3.3%, a sustainable payout ratio from a REIT, and they grow their dividend averaging over 5% growth over the past 5 years, and I think this company will continue to perform very nicely. Of course, you can find some other major REITs right now yielding over that 5-6+%. But once again, with regard to total return over the next decade and with future expected growth that will continue to outperform the other traditional office commercial style REITs, I think DLR is a nice addition and a top dividend payer within the real estate sector of the market. And their dividend is still considered very safe. Even when real estate was absolutely hammered because of the pandemic, they can still maintain a very safe dividend, coming in with a score of 94. Number 8, utilities. Duke Energy Corporation, ticker DUK. I own this company within my personal portfolio, a very nice high-yielding stock with a current dividend yield at 4%, and the share price is up over 9% this year. Of course, as I mentioned, they are the utility sector, and they are a regulated utility. So a lot of consistent cash flows coming into Duke each and every year. So they can support a higher dividend payout ratio because of the nature of utilities. They have some higher capital cost. So overall, they have a lot of depreciation of their assets. So net income from the net income perspective from the income statement is usually lower than expected. So that is why net income payout ratio from utilities is usually higher. But Duke Energy, one of the best managed utility companies in the world, has a current yield at over 4%. They grow their dividend at around 3.5% per year, and their dividend safety score comes in at 80, so it is considered safe. Sector number 9 in the market today, we have the Union Pacific Corporation. This railway company is up over 15% this year. They have a market cap of $139 billion, and they come from the industrial sector of the market. There are only a few main railroad companies that dominate the industry. And with the reluctancy to actually produce and build more infrastructure and build more railways within North America, the existing companies are expected to continue to dominate over the next decade with ease. Regardless of the people who want to get rid of railways, there are still some products that need to be shipped by rail, and that is the most efficient method of transportation. And with the existing infrastructure in place, UNP is well positioned to see some massive growth moving forward, and billionaire Bill Gates is one of the largest shareholders within a major railroad company, CNI, another competitor within this industry. If we take a look, they currently yield 1.87%. They only pay out around 49% of their earnings as a dividend, and they grow that dividend at a massive rate, averaging over 14% growth each and every year, with a very safe dividend coming in at 88. And last year alone, they grew that dividend payment by 21%. Number 10, 10th sector of the market, we're getting there. Ticker APD, up 18% this year with a market cap of over $60 billion. This company comes from the basic material sector of the market. And this is the smallest sector of the S&P 500, making up only 2.5% of the index. The company is up over 18% on the 1-year chart, and the material sector does not get a lot of love. A lot of companies people have never heard of, and kind of one of the smallest sector of the S&P. This is a sector of the market that people usually forget and do not include within their portfolios. But APD is a dividend aristocrat, yielding around 2% right now, averaging over 10% dividend growth each and every year, while maintaining a sustainable payout ratio of only 57%. And if you want to get a dividend stock from the material sector of the market, APD is a company you should definitely take a look at. Tied along with the very safe dividend score of 95, absolutely no worry of a dividend cut coming anytime soon from this material company of the market. And the final sector, the energy sector, the sector of the market that has been absolutely hammered in 2020. We're seeing a massive transition into more renewables, but one of the market leaders to this day is Chevron. Oil will still be around over the next decade. Of course, we will transition over a longer term to renewables, but over the next decade, oil will still be a major player, and Chevron, I believe, is so large that they will be able to maintain operations and continue to dominate the market. Over this past year, a lot of smaller oil producers and oil manufacturers did have to shut their doors forever because of the collapse of price in oil. But Chevron has maintained operational, and I think they will continue to grow moving forward. They've seen a recent bump as of late because oil prices have picked up, and the company is only down 22% this year, a nice recovery because shares dropped more than 40% in the month of March. So we know they come from the energy sector of the market. Their current dividend yield sits at around 5.6%. They are a dividend aristocrat, and the dividend, even with the tough time they're going through, the dividend is still considered safe, coming in at 65. And this was just reaffirmed on November 13th. So very recently, they got this new 65 rating, and we aren't really sure of a dividend cut over the short term. Throughout 2021, the demand for oil remains at this current level. Chevron's dividend will be safe over the short term. Of course, we will need to see an up peak in oil prices to sustain the dividend over a longer term, but as of right now, the dividend does seem sustainable. So thank you for watching, everyone. That was the 11th sector of the market. We went through all 11 sectors in today's video and picked a top dividend paying company from each. So please hit the like button, subscribe to the channel for daily videos about the market, and I will see you in tomorrow's video.